Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Jim Gold, CEO of Steward Partners, to discuss how registered investment advisory firms can manage organic and inorganic growth. Jim, it's great to have you with us. Welcome to TradeTalks.
Thank you. Great to be here.
All right, and you're the CEO at a Barron's Top 100 RIA firm. So before we get into managing growth, I want to, what are you hearing from clients? What are you hearing from advisors? S&P has had a decent run this year. Are we in a rally in a bear market, or is it something else?
I'm not sure. I think, listen, at Steward, we let advisors take care of that, right? So they manage money for clients. Most of our advisors are accredited, CFP, designated. And I think all the basic tenets apply, where they're using asset allocation, sector allocation. And ironically, if you think about it, if you have an asset allocation, you're counting on one of them to underperform, right? But most folks focus on the one that's performing well. So we're seeing a shift. I think our advisors there's not a wholesale shift, but I think there's more of a shift towards obviously fixed income, and when you can get 60 to 70% of the market's historical return with low risk, it probably makes sense to take a look at that.
Private equity has been leading the RIA M&A story for 2023, but Steward hasn't been actively seeking a PE partner, but rather family offices. Why is that a better fit, and potentially other RIAs in the industry going the family office route?
I think the funny thing, people don't realize it's easy to get money today. There's a lot of money chasing the RIA space. I think you have to be thoughtful around what is the right partner for you. So PE has absolutely a place. There's terrific PE firms out there. At the junctures we took in capital, we felt that the family office structure was more favorable to us. We thought it made more sense, and we wanted a partner at that time that had a long-term time horizon. So our first investor, I think the firm is about 400% larger than when they came in. The second one about 2.5 times larger. That was 2 years ago. So I think they're happy with what we've done, and we love to have them on our team.
How can RIA firms manage organic and inorganic growth for success, and what has been your strategy at Steward over the past 10 years?
Listen, I think the most obvious thing you have to look at is you have to have the right talent, right? You could put all the tools in the world in front of someone, but if they're not interested in using them, it's not going to help. Our advisors that we recruited in, and the firm was built from scratch. So 10 years ago, you and I would be the size of the whole company. So we've built a firm with really top-tier advisors who really embrace the opportunity to say, give me better tools and resources, give me flexibility. I want to follow all the rules, but our advisors that really embrace it have seen literally doubling their business in less than 5 years when we hired them.
How do you foster firm culture through what's been, corporate evolution and change certainly over the past 5 years? And why do you put such an important emphasis on equity for advisors?
I think the equity creates alignment, right? We want people to feel and know that they are partners. And equity, I think people sometimes think of it just as the advisors. Every single person has equity. So whether you're the administrative colleague or an ops manager or whatever, you're an equity partner at the firm. So there's a real difference when you say, I want to make decisions that the firm does well by, because I know I benefit from that personally, versus I work here and this is the company's rules. So I think that equity is really critical to what we do. It's completely unique in our business. There's no other firm that gives out equity the way we do. But I think the track record of success shows it was a good idea.
What's your outlook on the evolution of the RIA industry, and what does the future of RIA look like?
I think you see massive consolidation. You look at the numbers today, I think it's 80% of all RIAs are less than $500 million in assets. So the idea of a $5 billion RIA 10 years ago is a very significant firm. The new number is probably closer to $10 billion. I think that number is $20 billion in very short order here. So you need to have scale, and I think you're going to have this real difference between scale players and platform players and individual RIAs, which is nothing wrong with that, right? We could be 2J's investments, right, Jill and Jim, and that's okay. But I think if you're looking to have a real organization that's growing, you have to have a real top management team. You have to have resources. You have to have great technology. We believe in renting technology versus buying it, because we know it's going to be, all the stuff today is going to be in the dumpster in 3 years.
Yeah, well, especially the next generation of RIAs that are going to be coming on board. You have to recruit and retain that talent. You have the biggest, wealth transfer that's going to be occurring over the next 5 to 10 years. So technology is important for the RIA space.
Right, and I think it's also from where they come from. I think there's a sort of unknown evolution going on. If you look at the market share of the traditional big four firms versus today, and you look 20 years ago, the wirehouse firms had more than half of all wealth management revenue, and now it's in the 30s. Yet they talk about, which is true, they have record revenue, record productivity, record assets, but their market share keeps shrinking. It's coming over to our side.
All right, appreciate the insight, Jim. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.